welcome to Moneycontrol live stream. I'm your host Nickey Mirchandani, and today we're going to be talking about IKIO Lightning. Now, it's a Noida-based LED lighting solution provider, which is coming up with an IPO to raise around more than 600 crore from the markets. The IPO opens for subscription today, that's 6 June, and closes for subscription on 8 June. The price band is between 270 to 285 per share. But to know more about the company, we're being joined by the company's CMD Hardeep Singh and the director Sanjeet Singh.
Hi. Hi.
Afternoon there, gentlemen. I'm going to start off by asking you, it comes the first IPO in the month, which comes after the improved market sentiment. The IPO consists of a fresh issue for around 350 odd crore and an OFS offering too. How will the company now, how does it plan to utilize the fresh issue?
So basically, the fresh issue, the primary issue, which is 350 odd crores. Out of that, we have planned a capex of around 235 odd crores, and within that 235 odd crores, we are actually spending around 105 crores on the infrastructure. So we have, IKIO Solutions, which is a 100% subsidiary of IKIO Lighting. So there we have a 5-acre land where we have planned 3 state-of-the-art manufacturing towers, a total of 500,000 square feet that is going to be built up, out of which 200,000 square feet. The first tower is the building is ready. So that 105 crores we'll be utilizing in that, and another 98 crores is what we are spending on the plant and machinery. So that there also we have different segments, where we will be utilizing those funds in fixture manufacturing side of things, electronics, and there are different lines that we are expanding. So this is basically what we are planning with the capex, going forward, and another 50 is what we will be utilizing for debt repayment.
Fair point. Let's actually move on to the potential of the sector and the financials, and a little drilling down the concentration risk also, because the business generates around 90% of its revenue coming in from the lighting segment and around 50% from Philips itself. Now, what are the plans to diversify the concentration risk?
So we actually already have, multiple verticals, like you mentioned, right now around 50% is coming from Philips. That particular vertical is growing, at a healthy rate year on year. We've been seeing a growth in that. Then there are certain new verticals that, we have added in the past 5-6 years. Lighting and certain verticals, non-lighting related, but totally different to what we've been doing in the past for the Philips high-end home decorative lighting space. So those verticals are also growing at a very, very strong rate, and we are seeing a trend where the concentration of revenue from one particular vertical is constantly coming down, although that is also constantly growing year on year. But like I mentioned, the other verticals are growing at a much stronger pace.
Sure. How do you see the revenue mix stacking up from lighting and non-lighting segment for the next 2 financial year? From 90%, do you expect it to come down to 70%, 80%? How do you see that growing?
Actually, it would be giving, it is somehow related to giving out forward-looking numbers. So I'm sort of restricted on that. But the only way that I can tell you this is that all lighting, non-lighting, both the things are growing. And in lighting also, we have multiple verticals, multiple clients. Those verticals themselves are also growing. The number of clients are also growing. So it's a mixed bag of things that we have, and a whole host of products and verticals that we are catering to, which are very different from each other. But we are utilizing our strengths, similar strengths, the backward integration that we have, the ODM facilities that we have, most of the processes that we are doing in-house. So we are utilizing our strengths around the same. So that is where we see our growth going forward.
These are lighting. These are lighting as well as non-lighting. Means these are not conventional lighting. These are for the lighting for the recreation vehicles, lighting for the refrigerators. So it is not means the segments are totally different.
All right. I agree. I think you would agree to the fact that people buy more into the vision rather than hopes. Sure, at this point of time, the IPO looks to be an attractive, lucrative option. But if you talk about the cash flows, typically that we have seen in the last two financial years, FY21 and 22, the operational cash flows have been negative. Also, if you talk about the other things like jump in inventory, which has been higher for the last 3 months, receivables more than 4 months, and borrowing also to an extent. How do you see that trending? Any color on that?
Before I comment on that, I think the receivables right now are around 61 days for the first 9 months FY23. So not exactly 4 months, but yeah, 61 days the receivables are. Coming back to your question of the cash flows. So basically, I always tell everyone, if you look at the past 2 years, uh, an unprecedented situation happened globally for everyone, and that was COVID. So due to COVID, we had to, the lead times of the semiconductors and electronic components, which we have to import because they're not made in India. So the lead times, they went as high as 1 year, in certain cases even 2 years, whereas the generic lead times were close to 4 to 6 weeks. So from a 4 to 6 week lead time, straight away jumping to 1 year or 2 years. So that was a time where we had to do a lot of buying of these semiconductors and components, because even if you're short of one single component, which would cost nothing as compared to the overall product, but you are still unable to manufacture that product. So what COVID taught us was that we need to have multiple designs, multiple options. So I think we were one of the very few companies in the manufacturing of electronics who were able to sustain or even grow during COVID. So some of our verticals were constantly growing during COVID period as well. So that was only because of the fact that being an ODM, we were constantly able to change the designs and come up with alternate options if that particular component was not available. And that was one of the reasons why the cash flows were negative. But if you look at the FY23 numbers, the first 9 months, the cash flows are again positive. So that will continue. That trend, we believe, will continue to sustain.
And with those inventory and stocks, we actually encash that because other people don't have the inventory at that time, and we have the stocks and we get the business.
So we were able to add a lot of clients in different verticals as well because of the availability of material.
That's exactly what I wanted to ask from you guys, because most of the listed players, be it in the likes of Crompton, be it in the likes of Havels, Dixon, Ellen, the newly listed one, they've all sounded and indicated pressures on multiple counts, be it value, volume, and margins. So I would want to understand from you guys, can you split the revenue growth on volume and value front so as to provide us an outlook about that?
Can you come again?
Sure. I said your listed pairs like Crompton, Havels, Dixon, all of them at this point of time, they have indicated a pressure coming in on terms of multiple counts, value and volume and margins. I want to understand from you the split of your revenue growth on both value as well as volume growth front and your outlook way forward.
So we've been actually constantly growing in terms of, I would say the value as well. So if you look at FY22 numbers, we did, a top line of 334 odd crores. And in the first 9 months of FY23, we were able to achieve almost the exact same number, that is close to, I think, around 332 odd crores in the first 9 months of FY23. So you can see that trend, where we are growing in the revenue, and in terms of volume also we are growing that too, because if you look at our product mix and vertical mix, we have factories, multiple factories. Like we have four manufacturing factories right now. There is a fifth one which is coming up where the expansion is going to happen. So if I talk of the four factories, we are constantly growing in terms of the SKUs also that we are producing in those factories. So
The second is we will have a full product suite.
uh, handling around 600 odd SKUs in that particular in that particular unit. So this way, we are growing in both, I would say, value and in terms of quantities as well.
That's
And
a
also because we are not into the like commodity products, so we the quantities are doesn't matter to us because we are not into the commodity products at all. So we are in all the four segments. We have the niche products with the niche customers.
So if you look at the business, how we have planned the entire, all the four verticals. So we are basically doing customization at a scale. So all four verticals, we are doing ODM. So we are adding, a lot of creativity and, value to the product, and that has been our strength all along.
Right, it's playing on the strengths and speaking about the strengths. Let's talk about your order book and especially the ones that comes from export side of the business because that segment has been growing thick and fast. What's your outlook there? How do you see the growth shaping up for that one?
Actually, we represented means India as a nation, and we are giving the China one to them. So right now we are focusing only the USA marketing. We are we can foresee good growth in that segment particularly, and we are going to participate in the shows there. Like we entered into the recreation market component, so we are managing those also. So think because for USA market you need lot of certifications and the quality and standards. So that part we have already finished. Now it is the time for the products to be launched in a different way.
So, sharing the order book would be like giving out future looking numbers. So that is something that we cannot do. But for that matter, we know that where we are growing, and like I mentioned, these are one of the new verticals that we have, and they are growing at a very strong rate. And going forward, this trend will, momentum will continue.
All right. So, and the last question that I have in my mind, of course, is we spoke about the entire order book from exports. What about the competitive landscape? Because Chinese players are the most cost efficient tariff. The overall freight rates have been coming down. Do you think there is more room of competition coming in from Chinese players in the coming months, and that could hit the financials of the company?
The thing is that the China labor problems are coming up in a big way, and the cost of the labor in India and in China, it's a huge difference. It is a difference of about 4 times. Like we are 4 times cheaper than the China, and the work cultures now because of our strength in the manufacturing, we are maintaining our all the factory standards like the China or the Taiwan or the countries we have already visited. So the working culture and everything we are maintaining that standard, and the labor cost is much cheaper. As I told you, it is almost 1/4 of from the China. So we don't feel any competition from them at all. And because we have the backward integration, that plays a major role in our costings.
All right, sir. We'll leave it at that. Thank you so much for taking out the time and speaking to us.
Thank you very much. Thank you.
Thank you so much for having us.
Thank you.
All right. That was the management of IKIO Lightning. At this point of time, says the cash flow has been positive in the first 9 months. Sounded pretty optimistic when it comes to the order book from the exports, and also sees very little competition coming up from the Chinese players, given the cost efficiency that the India is sitting at this point of time. But guys, with this, it's a wrap. Thank you so much for tuning in.